facing the unknown of the coronavirus and bringing the presidential race into focus. This is Bloomberg Wall Street Week. I'm David Westin. Welcome back. We'll sit down with Brian Nick.
What I'm more concerned about is we haven't seen a capitulation yet on earnings expectations.
Nuveen, chief investment strategist, and Dambisa Moyo.
Greatest concern is that the U.S. seems to be sort of alone as a growth engine that hasn't stalled as quickly as many other regions.
Global economist and author of Edge of Chaos. And our special guest, contributor Larry Summers, former U.S. Treasury Secretary. It was the week that the coronavirus came to Wall Street and to much of the world as cases began popping up from Los Angeles to Berlin, from Switzerland to Brazil. And central bankers around the world warned about the risks to the global economy.
What really matters, of course, is not the epidemiology, but the risk to the economy. So we saw a risk to the outlook for the economy and chose to act.
The Bank of England's role is to help UK businesses and households manage through an economic shock that could prove large, but will ultimately be temporary.
Coronavirus has now turned out to be a global problem. So when the problem is global, naturally the need for coordinated action is so much more.
The bank will take all necessary steps to support the UK economy and financial system consistent with its statutory responsibilities.
And they didn't just talk. At least one of them, the Fed, acted by abruptly cutting rates by 50 basis points, though it apparently acted on its own despite all that talk about coordination. And whether coordinated or not, the markets didn't seem to like it. When it comes to responses to potential economic crises, there's no one with more experience than Larry Summers, who dealt with them as U.S. Treasury Secretary and as President Obama's senior economic advisor. He is a Wall Street Week contributor and our special guest. Joining Larry is our Wall Street Week panel with economist Dambisa Moyo. She's veteran of the World Bank and Goldman Sachs and author of Edge of Chaos, Why Democracy is Failing to Deliver Economic Growth, and Brian Nick, chief investment strategist at Nuveen, where he sits on the TIAA Asset Allocation Committee. So welcome all of you. Larry, I want to start with you. Play a little game, Goldilocks. If it's too hot, too cold, or just right, how did the Fed get it this week?
I don't think that it was sensible to have a G7 meeting talking all about global cooperation, conclude with no acts of global cooperation, and 2 hours later have the Fed act unilaterally. I think the Fed, by moving 50 basis points out of sequence when there wasn't a meeting, something that was virtually without precedent, it's only happened 2 or 3 times in the last quarter century, they left the impression that they must be alarmed about something, so people outside the Fed should be alarmed as well. That's not their mandate to calm things down. And they raised the concern about the efficacy of their tool. They only had 150 basis points left, if that. They dissipated 50 basis points, plus all the extra noise around moving between meetings, and they didn't really do anything that stabilized markets, which were falling faster after they acted than they did before. And so they would have been much better advised to move more slowly, to use their tool as a kind of sword of Damocles. Now they've fired off much of their weapons to no evident effect, and that can't make people feel better about the situation that we're in. So it was not a particularly good week for the Fed. And in addition, they have to have reinforced concerns that they're not entirely independent in their decision-making of the president. I'm not saying that's the case, but by taking an unsuccessful large action right after he demanded it, there has to have been some impact.
Yeah, and
so
Dambisa,
not a good week for the Fed.
By the way, the president's reaction was, that's not enough.
Yes, he was very swift off the gun. Larry, hi there. I just wanted to pick up on your points and maybe ask you for a bit more perspective. In terms of directionality, it sounds like you agree that, ultimately we needed a cut. I just wonder, it seems to be you're quibbling around the magnitude. I wonder also if you could comment after you talk about whether it should have been 25 basis points on what you think the next step or might be from the Fed, given what has subsequently happened. Do you think that they're going to wait to see more numbers from the economy, or do you think at the scheduled meeting they will react given what's happening in the markets now?
I think when you have only so many bullets, you have to be very, very careful in their use. And sometimes a weapon in reserve is much more potent than a weapon fired off to no great effect. So I think 25 basis points would have been better. My guess is that given what they've done, they're likely to find it hard to avoid moving at the next meeting, but they are running themselves out of ammunition. And ultimately, I don't think this is going to be about monetary policy and interest rates. I think the principal financial question people should be concerning themselves with is not the price of credit, but is the quantity of credit, is what's going to be done when, in a sense, economic time has been stopped, but financial time has not been stopped. So airlines that have ongoing debts but aren't going to have willing passengers for a significant period of time. Others who've paid to lay in inventories but aren't going to be able to keep their places of business open because of the virus. I think the question of how we're going to manage the financial distress is a crucial one. And I think that you're going to start to hear, and frankly, I'm going to have sympathy with it, the question raised of when the banks were in trouble, we stepped up and provided a variety of kinds of funding. Shouldn't we find some ways to respond to the businesses that are going to be in distress? And I think that's what the Fed and the Treasury should be thinking about right now.
That's a terribly good point.
And that might be one reason why the Fed felt they needed to do this week, because they weren't seeing action on these other fronts. So might as well to try to do their best to deliver what I think they thought probably would be a dovish surprise, which the Fed likes to do. They like to come out surprise on the dovish side when times are tough. But instead, what you actually saw happen was the 50 basis point rate cut that was priced in for March that they thought they were preemptively delivering this week, it just got repriced in.
Yeah,
so the market is now demanding essentially that they cut rates to zero.
The choreography was a calamity. I mean, what was the reason for foreshadowing it on Friday, except to assure that you'd create a buy on the rumor, sell on the news situation?
That's a great point.
What was the reason for continuing to have leaks coming out of the system early in the week? I don't see how they could have thought that this was going to be highly effective. The right thing to have done was to have caused people to be in doubt about what would happen, and then perhaps belatedly to deliver something just when people thought you might not do it. I think you also cannot underestimate the challenge of making policy when people think you have more power than you actually do. Yeah. And there's this enormous pressure to act, but if when you act, what you're really going to do is reveal your own weakness, you have to be courageous enough, even when everyone's clamoring for action, not to act.
Yeah. Spoken like somebody who's dealt with an economic crisis or two in his career. Thank you so much. We're going to be back with our contributors and special guest, Larry Summers. Coming up, Wall Street works from home. We take a look at the realities of a COVID-19 world of remote banking with SIFMA President Ken Bentsen.
There is experience with this, but again, there's always issues that are coming up, and we're identifying those right now, and we're in discussions with our regulators on a real-time basis of, how do we figure out how to work through this?
This is Wall Street Week. This is Bloomberg Wall Street Week. I'm David Westin. The coronavirus is hurting the economy just as it's causing deaths around the world. But we cannot know at this point how much worse it will get on either front or when things are going to turn around, leaving CEOs with a big challenge in looking out for their employees, responding to demand and supply shocks, but also in preparing for a rebound when it happens. Banks are dusting off their emergency plans to preserve operations, which brings to the forefront a host of issues when traders can no longer work from their trading floor. JP Morgan plans to send hundreds of its New York and London trading staff to backup locations, and Citigroup is reviewing its redundancy sites in New Jersey and in London. And there's even talk of trading from home. Joining us now from Washington is SIFMA President and CEO Ken Bentsen. Dambisa Moyo and Brian Nick are still with us. So, Ken, thank you so much for joining us. Give us a sense. We're reading some about this. What are the big banks doing right now as they contemplate the possibility they will have to evacuate some or all of their premises?
Sure. Well, first of all, thank you for having me. So this is part of the regular business continuity planning that the industry does across the industry, from the largest to the smallest institutions, on a regular basis. And we go back, if you look at different events we've been through, from 9/11, financial crisis, SARS, Superstorm Sandy, and we try and learn from each of those, as well as the training we do in between. And so for the past several months, as the coronavirus has started in China, we've been liaising with our members along with our colleagues in Asia and in Europe, and to your point, dusting off the playbooks that firms have developed of what do you do if you can't get into the office, if you have to send people home, you have to send people to remote locations or redundant locations, all of which the firms have. And again, every time we learn something different, we make changes for it. So what we see going on now is, again, firms looking at where can we put redundants, where can we do things off-site at redundant sites? What are we going to have to do if we have to send people home? And then beyond that, what are the operational and compliance issues around that should be considered? And so we're talking through if someone is at a redundant site, you have certain protocols for that, certain connectivity issues for that. But if you can't get in to deal with physical securities, how do you address that? How do you deal with various filings that you have to do? From home, you have certain issues around supervision, recording of communications and the like. And again, we're talking to our regulators about how would we work through that? Is there a way to work around those during this process if we get to that? Because the goal is to be as ready as you can possibly be when that moment comes. And you don't know, and you hope it doesn't happen, but you don't know when it's going to happen.
So I'd love to hop in here. I actually served on the board of a bank for almost 10 years, and I can assure you that a lot of tire kicking has been done over the years for a multitude of different reasons, many of them that have already been mentioned in terms of previous shocks. We have resilience plans in place. Not only was I on the board, but I was also on the risk committee. So issues around mandate and scale and how we parcel out risk among traders is something that we're very au fait with in this industry. Now, that's not to say that these things don't need to be dusted off and really are being tested in a live scenario, but I would like to reassure people that it's not starting from ground zero. These are plans that are required by regulators to be reviewed and tested on an ongoing basis in order to ensure that there's a sort of fit for purpose operations for this organization. Remembering, of course, that we also have to make sure that this is a systemic risk issue. So this is a very, very serious issue, and it is being taken care of, I would say, on the whole.
That's right. If I might interject here, you're absolutely right. And it's very much an iterative process that you go through, because we learned things after Superstorm Sandy in terms of where redundant sites were, and if you couldn't get to those, what do you do? Could you trade? Could you open the exchanges non-physically or electronically? There were questions around that. And a lot's been learned since then. But there'll be, if this happens now, we'll learn from this exercise as well for the next one.
Ken, do you have any sense of how your members are doing right now as they dust these off and they try to see how they're working? Are people running into glitches? Is it all going smoothly?
Well, I think the good thing is they're moving forward with the exercises now. And you're already seeing firms are obviously implementing, various travel bans and other types of issues. We hear, firms are talking about beginning to move people remotely to test how it would work, having some people at home, different people coming into the office at different times. And by the way, and I was on the phone with my colleague, our Asian affiliate this morning, they have obviously been going through this for the last 5 weeks. So there is experience with this, but again, there's always issues that are coming up, and we're identifying those right now, and we're in discussions with our regulators on a real-time basis of, how do we figure out how to work through this?
I think from an investment standpoint, what's interesting is that you mentioned dusting off playbooks for how to deal with this. It's not just the work from home, off-site contingency. It's also keeping your employees physically safe. And this is different than a natural disaster. It's even different than a terrorist attack in a lot of ways, because you have this ongoing risk that doesn't necessarily sort of wax away on a daily basis. Trying to figure out, which companies are best equipped to handle this. If you've been doing the work when it comes to sustainable investing, ESG factors, a lot of times we think of that as being environmental, but people ignore the G for governance. Having contingency plans in place, secondary sites, how dispersed are you geographically? Are there going to be places where the virus is worse, some places where it's not as bad? Undoubtedly, the more different kind of footprints you have, the better equipped you are as a business to handle this kind of thing.
Yeah, and Ken, one of the issues for a lot of businesses, including banks, is you have employees who can no longer come to work, not because there's something wrong with the workplace, but because they have children, for example, who are not in school anymore. They have to take care of those kids, or they might get quarantined at home. How are the banks dealing with that issue about people really having to take some time off and stay home?
I mean, that's a very good question, and that's something that certainly the firms are considering is whether it's contingent issues that you have because of schools being closed or transportation concerns, and I would say also the number one priority of the firms that they tell us is the health and safety of their workforce to begin with. That's their most important asset that they have. And protecting that asset is the most important thing they can do. So that's why you have these playbooks. You go through the testing. You figure out if we can't have people come in for whatever reason, whether it's directly because they can't get into the building or they can't get to the location, or because of something like their kids are being out of school. Those are all the things that are in consideration right now.
Okay, Ken, thank you so much for joining us. That's Ken Bentsen.
Thank you.
He's SIFMA President and CEO. Let's stay with the roundtable here with Dambisa and Brian at the moment. Dambisa, I want to pick up on something that Brian talked about, which is the governance part of ESG, because you sit on some important boards. Yes. Give us a sense, beyond the banking sector, about how a CEO, how a board, how senior management deals with a situation which can really be a substantial, unexpected downturn, such as we're facing right now.
So, I think what's really important, taking a step back and thinking about what is the actual mandate of the board. The board, in many respects, has really three roles. One is to oversee and provide input in terms of strategic, long-term thinking. We obviously get short-term, medium-term, and long-term discussions around what the strategic plans for the company are. The second, these, by the way, are not in order. The second mandate role is hiring the CEO, or firing, hopefully not firing, but hiring the CEO, and obviously a whole lot of what that entails. The third aspect is really around culture, which is somewhat new, and I think a lot of the G and the ES fall into this sort of broader cultural area.
Coming up, Wall Street Week contributor Larry Summers on the legacy of Jack Welch.
I think Jack will be studied because it's really the example to study to understand a crucial period in American business history.
This is Wall Street Week. This is Bloomberg Wall Street Week. I'm David Westin. The corporate world lost a legend this week when Jack Welch, longtime chairman and CEO of General Electric, passed away at the age of 84. Under his leadership, GE's market cap went from $12 billion to $410 billion. And his successor at GE, Larry Culp, told me this week that his influence there lives on.
His focus on talent, the way he pushed our company to globalize, his emphasis on not only manufacturing new equipment, but servicing it and using that to get close to the customer. And those are really the hallmarks of GE in many respects today, just as they were in his time.
We welcome back now our Wall Street Week contributor, Larry Summers, for his thoughts on Jack Welch and his legacy. So, Larry, we'd understand why Larry Culp and GE really remember Jack Welch, and we remember him fondly. But what about the rest of us? What about the business world? What about the world of finance? How do we remember Jack Welch? What will be his lasting legacy, if at all?
He was the greatest CEO of his kind in the last third of the 20th century. Clubbable with the rest of the CEOs, driving for performance, focused on the numbers, of which the most important was the stock price, ready to deploy and redeploy assets in any direction, seeing the world, not the United States, as his space and his market. Those were all his attributes, and he was in many ways the apotheosis of his era, certainly the one who created the most stock market value. But I don't think that his legacy will be as long as he might have hoped it would be, either at GE or in American management generally. GE, more or less since the day he left, has been a catastrophe for its shareholders. During a period when the market has gone up spectacularly over the 20 years, GE stock is substantially lower than it was the day that Jack left. Jack's proteges who went on to other companies, Dave Cote was a fantastic success at Honeywell, but the two others who were most in contention to succeed him have rather mixed legacies, having created the culture of Boeing, which is not highly revered today, to put it mildly, and having not been so successful at Home Depot and at Chrysler. So I think that the world is in many ways moving past Jack's concept of aggressive, if I might say, masculine management by the numbers for the share price, and the values that we emphasize today are a rather different set of values than Jack embodied. So I think Jack will be studied and his career and what he did at GE will be studied because it's really the example to study to understand a crucial period in American business history. But I don't think it will be mined for its lessons for corporations going forward.
Yeah, really interesting. A man of his time and perhaps not another time. He may not be alone in that regard when you look back at great men and women through history. Thank you so much to our special contributor, Larry Summers. He, of course, is the former U.S. Treasury Secretary.
Coming up, a Super Tuesday for Joe Biden. We'll dive into what the former vice president's surge could mean for markets.
I would say nothing that we saw is surprising. I think that, if anything, there was a lot of concern in the marketplace around Bernie Sanders' win, not only at the primaries, but ultimately whether he could take on President Trump.
This is Wall Street Week.
Welcome back from New York. This is Bloomberg Wall Street Week, and I'm David Westin. It truly was a Super Tuesday for Joe Biden this week when his campaign for president roared back after appearing to be on life support, with wins in 10 of the 14 states going to the polls and his unexpectedly surging ahead of Bernie Sanders in the delegate count. And in case you thought investors weren't paying attention, well, they were. Equity futures climbed through the night on the prospect of a Biden victory. And healthcare stocks particularly liked the idea of Sanders not getting his way on Medicare for all. Or just maybe it was the notion that maybe we'd have some predictability and it might come to an industry that accounts, after all, for nearly 1/5 of the overall economy.
Having a predictable, sustainable healthcare market depends on legal and regulatory certainty about who's going to have to be buying health insurance.
We are back now with our Wall Street Week roundtable of Dambisa Moyo and Brian Nick. So let's pick on healthcare just for a moment, because boy, it really moved. If you looked at the marketplace, it really moved as that night went on.
Well, I would say nothing that we saw is surprising. I think that, if anything, there was a lot of concern in the marketplace around a Bernie Sanders win, not only at the primaries, but ultimately whether he could take on President Trump. I think, the fundamental question is, has this now been put to bed? Because there's fundamentally, particularly in an era of coronavirus, I think many Americans might say to themselves, well, actually, I am kind of exposed here. Where am I going to get health care if this thing became quite problematic? So I don't think we're out of the woods yet, but I think it was definitely a win for presidential candidate Biden.
Yeah, no question about that. But what about as investors? As you look at healthcare, as I say, it's about 18% and rising as a percentage of GDP. What do you make of that as a sector? And I really want to pick up on what Dambisa said. We now have a coronavirus. Does that change the equation some, because people may be more concerned about security, as it were, in healthcare in a way they weren't a year ago?
I think it's harder to analyze what happened on Super Tuesday and then before that what happened in South Carolina. It's so rare you get these rapid turnarounds that really allow you to kind of look at, gee, what moved when you had Sanders' chance go down and Biden's chance go up. Healthcare was one of those things, but even going back to last year, we know that sort of an unnaturally large percentage of people began paying attention to the election early, and I think that was true of the markets as well. Healthcare was one of our favorite sectors last year, didn't start to outperform until the latter part of the year. We think a lot of that was the political risk and the uncertainty with just who the Democrats might be putting up and what their position on healthcare might be. If you track from the Iowa caucus through this week, the relative probability is in sort of the political odds makers of Biden versus Sanders tracks pretty closely with the relative performance of healthcare up through today. You saw it on Monday when other candidates were dropping out and endorsing Biden, healthcare was spiking, and then when Super Tuesday happened, we saw it spike again. Again, hard to tease out in a very difficult and volatile market environment, but that's clearly one of the takeaways from the markets is they're pricing out risk, long-term risk to healthcare.
Dambisa, we saw it most dramatically, I think, in healthcare. What about other sectors? I mean, you know a fair amount about energy, oil companies and things like that. Are we seeing it in oil companies as well? Because we do have some candidates with some pretty extreme positions, for example, on fracking.
Yes, well, I'm not here to speak on behalf of these companies, but I will speak generally about the energy sector. There are 1.5 billion people on the planet today who do not have access to reliable, cost-effective energy. The consequences and second-order effects about living standards, education access, healthcare access are material. And so the fundamental question we have to ask is there a need for these companies to be in there producing energy? And to me, the answer is absolutely yes. If you don't buy my answer, look at what the International Energy Agency, IEA, is forecasting. It even in the most conservative view, or I should say aggressive view, where energy companies and fossil fuels are sort of beaten down, you still have a big proportion of energy contribution coming from these countries and companies, over 80% in 2050. So really, I don't see how fundamentally the energy companies are not a buy, and I think they have suffered a lot. Partly the relative value versus the tech companies, but more fundamentally, I think there's a very wrong narrative out there around what they're doing in terms of renewable energy, and ultimately the fundamental lack of energy around the world.
Yeah, well, what about tech? I mean, Dambisa actually just mentioned tech. Tech companies also have come up with a lot of criticism on the regulatory front, particularly the really big ones, the Facebooks, the Googles of this world. How does the tech sector look to you as an investor in a new administration, maybe a Democratic administration? That seems to be more of a possibility now, given some of the weakness apparently on the horizon for the economy.
Yeah, it's also under bipartisan scrutiny, not necessarily for the same
also
reasons.
Also true, good point.
But if you get any kind of agreement between, say, a Democratic White House and a partially Republican Congress, that might be one of the things that they can agree on is sort of, getting a little bit tougher on tech. I think one thing that, and you don't see it in the markets clearly this week because there's so much other volatility, is that you have had Biden talk more as sort of a compromise candidate, less likely to use regulation or sort of unilateral measures as policy than some of the other candidates. And I think we don't quite know yet what the polls are going to look like, how this is going to shake out in the general, but I think the range of outcomes, assuming he's the nominee, as looks likely at this point, has probably shrunk a bit. So the tail risk associated with more stringent regulation of technology, fracking ban, single-payer healthcare, I think those have started to melt away, if not completely gone.
So, Dambisa, to put you on the spot here, President Trump ran as a pro-growth president, and that was part of the reason for his tax cuts, certainly his deregulation moves. Is it realistic to think we could have a Democrat run on pro-growth, or is there necessarily something of a differential in the projections of economic growth under Donald Trump, who's running for president again, as opposed to any Democrat?
Well, I mean, I think that there's a sort of rule of thumb when I was on the Goldman Sachs trading floors many years ago, was don't think about what politicians and policymakers should do. Think about what they will do. And we know that the Congressional Budget Office, the CBO, is forecasting significant pressures by 2030 around the U.S. fiscus, both in terms of debt, but also in terms of deficits. We're already looking at $1 trillion deficit this year. So when I think about corporates and generally incomes and living standards in the United States, what is it that I know to be true? And for my sensibilities, regardless of a Democratic or a Republican presidency, I think ultimately we know that taxes are going to rise.
Well, that's interesting. We have to worry about the fiscal side. At the same time, we don't hear about that from either side. Yeah. There are no fiscal hawks left.
There's no plans to reform Social Security or Medicare on any of these platforms.
We're not going to touch those entitlements.
What's interesting is if you compare the growth during the second Obama term versus what almost is the completion of the first Trump term, the biggest difference is fiscal policy. Extremely loose during the Trump administration and extremely tight during the second Obama term because of the mix of government. So what happens when you get a Democrat in the White House and you have at least a partially Republican Congress, that's the only scenario where I think you get fiscal tightening because the Republicans don't want to give the Democratic president everything they want in terms of the budget and the appropriations. So that is what you could see a replay of if you do get a change in the White House in 2021. Is you could see, at least on the discretionary side, some of these kind of budgetary constraints start to come back in.
This is a great point. You give me some hope because every poll says most Americans want a split government. Maybe there's a good reason for it. Maybe it's more fiscally responsible. I never heard about that.
But they don't touch the long-term issues.
Yeah, not the entitlements.
It's all about the sort of,
not the entitlements.
Yeah.
That's exactly
it's not the meat
right.
and potatoes. It's the parsley that gets taken away.
There you go. Okay, we're going to be back with our contributors, Dambisa Moyo and Brian Nick.
Coming up, an infectious disease doctor joins us for a second opinion on how bad COVID-19 could get in the United States.
Why is it that we approach our military defense security differently from the way we approach our biosecurity?
This is Wall Street Week.
This is Bloomberg Wall Street Week. I'm David Westin. We can talk all we want about supply shocks and demand shocks and corporate responses to a coronavirus outbreak, but let's face it, at this point, the fate of all of us really lies with the scientists and with the doctors and what they can tell us about the disease and what they can do about it in the end. For a second opinion, and yes, this one is a medical second opinion, welcome now Dr. Celine Gounder. She's infectious disease specialist and epidemiologist and clinical assistant professor at the NYU Grossman School of Medicine. She's coming to us today from Boston. Dr. Gounder, thank you so much for being with us. What should we know that we don't know about this disease at this point? And maybe just as important, when will we find out?
Well, in terms of what we don't know, there's still many things we don't know. There's been a lot of fixation on what is the case fatality rate. So in other words, what percentage of people who get the disease will die from the disease. And there's been some controversy about which of those numbers is correct. As you may have heard our president on Hannity yesterday disputing the WHO figure of about 3.4%. That number is probably not correct. And here's why. That number is an average of the case fatality rates for a number of different countries. And what will be the case fatality rate in one country is not necessarily what you'll see in another, because you have different kinds of healthcare systems, different levels of infection control and preparedness, so that you're going to see a range of numbers from place to place. So looking at averages isn't really helpful here. I do think this is worse than the regular seasonal flu. And we need to really focus on the populations most at risk. So that is the elderly, especially people in their 70s, 80s, and above. But we do see an increased risk over the age of 50. The other groups that we worry about are people with chronic medical conditions, and that includes a whole host of things. So that could be heart and lung disease, liver disease, kidney disease, somebody who has diabetes, somebody who has autoimmune disease or needs to be on immunosuppressive drugs, somebody who's currently undergoing treatment for cancer. So there's a wide range of people. And we should never forget our healthcare workers who put themselves on the front lines at risk for exposure. And if we see a lot of healthcare workers getting infected, that could cause a lot of problems downstream for the rest of the health system.
So I'd just like to hop in here. You know, a few years ago, I sat next to Dr. Tom Frieden, who was the head of the CDC. And at that time, he made the comment that we should expect that there would be many more communicable diseases coming through. He had already cited SARS and Zika and Ebola, et cetera. I just wonder a little bit, why is it that the medical community seems to have been a little bit back-footed in this instance? Perhaps it's not that the medical community is back-footed. Perhaps it's that the rest of the world wasn't paying attention to this risk. I had written an article about why this was being an issue that was being discounted in the market. Could you just talk to us a little bit about what you think has been missing in terms of the broader discourse in public policy and in financial markets, and more importantly, how can we improve? Because this sounds like the prevalence and incidence of these communicable diseases is going to only increase in years to come. And what sorts of things we should be doing to avert a further crisis?
Well, one of the big lessons after Ebola was understanding that this is a problem that crosses different sectors. It's not just about health and medicine and workers in those fields. You really need to have Department of Defense, finance, all across the board. You need people involved in the response. And I think a big mistake was that the White House Office of Pandemic Preparedness and Response at the National Security Council was eliminated. And you really need that high-level intersectoral collaboration on these kinds of issues. So that was a big mistake. I also think, and I really don't understand this one, why is it that we approach our military defense security differently from the way we approach our biosecurity? So you would never say, let's just build a wall around the country and put our military at the wall, let's get rid of all the foreign bases. You would never do that. That would not make any sense at all. And so we need to think about global health in that same way. So there's a reason we need to be on the ground helping build up surveillance systems in countries around the world. That's an essential part of our biosecurity. And it's, yes, we're helping them. We're doing something that will be good for those countries as well, but it's very much a self-interested kind of outreach.
Dr. Gounder, obviously the primary risk here is to health crisis and people's ability to get health care if they are dealing with the virus itself. But the secondary concern, and something that people like me have to think about, is what is the economic cost going to be here? And if we start to see even a sort of a soft quarantine or self-decreed isolation where people are staying home from school, staying home from work, we know that's going to have an economic cost. So my question for you is, if that starts to happen, how long do you expect people are going to need to hunker down to wait for this to pass? Because it matters very much how long that period of time lasts until we can kind of gauge what kind of economic shock this is going to ultimately constitute.
Well, I mean, I don't have a crystal ball any more than you do, but I think a couple things I would say is what we're really trying to do is slow the spread of the infection. And once you get to the point of community spread throughout the country, then some of these measures may not really be helpful anymore because the cat's out of the bag fully, so to speak. So at that point, you may really just focus on, say, nursing homes and the elderly and doing what you can to prevent their exposure because they're at highest risk. But if it's everywhere, does it make sense to have people working from home? Maybe not anymore. So it's really trying to buy us some time right now that we may be making some of these recommendations, because if you have these big spikes in cases at hospitals, that will cause a problem. It will make working conditions unsafe for nurses and doctors. It'll lead to delays in healthcare. If you come in with a stroke and the emergency room is flooded with patients, you're not going to get attention for that stroke as quickly as under normal circumstances. So what we want is to try to at least smooth out how these cases develop over time and buy ourselves some time, be a little bit more prepared. But I think inevitably this probably will spread through much of the population over time. We just want to try to limit the fallout from that.
So, Doctor, I think maybe an ultimate question we all have, that's for ourselves, for our families, but also for corporate leadership, for investors, is how bad could it get? We had Bill Gates write in the New England Journal of Medicine that he thinks we should take seriously the possible. This is along the lines of the Spanish flu, and he gave it two reasons. One is what he called the efficiency of the disease, that one person can give it to 2 or 3 other people, and the other is the lethality, not just for some of the people who are compromised, like you said, but some healthy people. Is he right?
I don't want to say he's right or wrong per se, but I think the worst case scenario is the Spanish flu. That's certainly sort of the upper limits of what we might see with this. I think one good thing is we haven't seen younger people affected by this in the same way that we did with the Spanish flu. I mean, really the largest burden has been in people over the age of 50, and especially people over the age of 70. And as I mentioned earlier, people with chronic medical conditions who could be younger, and healthcare workers. And healthcare workers are potentially at risk for being exposed not once, but many times and in much larger doses. If you remember Dr. Li, the ophthalmologist in China, well, think about when somebody examines your eye with what we call an ophthalmoscope, that special scope with a light that they use to look into your eyes. They're literally face to face with you. So that those are just very different exposures than the average person is likely to have.
Just really quickly, a point of clarification. When you say it could be akin to the Spanish flu, are you talking about the notional numbers, because there was about 50 million, but the world's population was much smaller at that time, or are you talking about proportionately? Larry Summers, who's a contributor on this program, put out a statement, or an article yesterday in the Washington Post, where he thought that the upper bounds would probably be sort of worst case scenario around the 7 million mortality rate. I'm not saying that that's better or worse, but I'm just trying to understand what your reference point is in terms of that comment about Spanish flu.
Yeah, I'm referring to the case fatality rate. So right. upper limits of 2%. I think most likely we're probably looking at more in the 0.6 to 0.8% range, at least as would be applicable to us, at least based on the data that we're seeing out of countries like Singapore and so on, that are with health systems that are more similar to ours. So I think part of the problem right now is not every country's healthcare system is comparable, and so what you see in terms of statistics coming out of China is not necessarily exactly what you're going to see here.
That's really interesting. That makes President Trump closer to right in the numbers he talked about this week. That was more the numbers under 1% is what he was talking about. So he would find that as very good news, as we all would, compared with a 3% number. Okay, thank you so much to Dr. Celine Gounder.
Coming up, what Wall Street's watching in the week ahead.
The issue the ECB has is they're already in emergency monetary policy mode. They're already doing quantitative easing. They've already cut interest rates to negative levels, so they don't have that many other levers to pull.
This is Wall Street Week.
Welcome back to Bloomberg Wall Street Week. I'm David Westin. We have talked about the last week on global Wall Street. Now it's time to look forward to what the coming week is likely to hold for the business, investors, and global economy. Now let's get thoughts now from our contributors with Dambisa Moyo and Brian Nick. Brian, I want to start with you. The ECB, the Central Bank of Europe, is going to meet this week. We're going to hear from Madame Lagarde. What should she say? What will she say?
I think she has the benefit of being relatively new, so she still has credibility, both with the sort of the central banking community, but also within Europe. The issue the ECB has is they're already in emergency monetary policy mode. They're already doing quantitative easing. They've already cut interest rates to negative levels, so they don't have that many other levers to pull. I think she will bang the table, pound the table on fiscal policy. But I also think she's going to try to talk down the euro. I mean, one of the things that we've seen, especially since the Fed cut interest rates, is the euro's been going up, and that's not good for Europe. We know even if we hadn't had any of this coronavirus risk, Europe was still struggling coming into the year and was still due to grow about the weakest of any of the major economies. So she's going to have her work cut out for her, trying to, again, deliver that dovish surprise that central bankers typically look for. I think she's going to have to do it mostly verbally, but also trying to twist the arms of other policymakers in Europe.
Dambisa, she does have one tool, which is targeted lending, that the Fed doesn't have, actually. Should be pulling that trigger on targeted lending for some parts of the economy that might get hurt.
Yes, well, so the European backdrop is pretty tough. They've had a couple of 0% growth rates in Germany. The auto sector has really been hammered there, and nobody needed the coronavirus in Italy, which is hurting the tourist environment. So the question is what tools do they have? And as Brian rightly pointed out, there are negative interest rates. The story is pretty complicated. I do think that targeted lending is going to be on the table, even here in the United States. And maybe this is a great segue into the other piece of the puzzle, which I think is coming in next week, which is
fiscal stimulus.
Fiscal stimulus, which is very highly likely and very expected in the UK context. We are seeing increases in the numbers of coronavirus coming from from travel in Europe, in the UK, and there's great expectations that the government, a new post-Brexit government, albeit conservative, will put in a lot of more loose fiscal policy initiatives in the budget next week. For example, one of the speculations, I was just in London yesterday, is around the fact that we may start to see a lot of support for and targeted lending towards small businesses and what they call zero contract workers. So to encourage them to stay home, and Brian, you mentioned this, alluded to this earlier, basically providing a helicopter dump of money to support these types of people who are not able to actually make it to work. So a lot to see next week. I do think we're going to see more. We're going to see a lot of what happens in monetary policy through the ECB, but also what's going to happen in the fiscal policy. What sort of initiatives and innovations come from there as well?
So Brian, it reminds me of your remarks about divided government. We had a big win by Boris Johnson. He's got a significant majority, so maybe he has the flexibility as a conservative, the irony being conservative, as a conservative to spend a lot of money.
And he doesn't have to worry about divided government except for maybe the House of Lords. So this is something, this is not unique to this moment. We have seen, ostensibly conservative governments become much more fiscally loose. There's no political constituency out there. Very few people are going to vote for you if you promise to cut the budget. And I think even conservative governments are figuring this out, which is why you've seen sort of this realignment in the United States where Republicans are much more tolerant of deficits, long-term debt, growth, even discretionary spending, not just military spending, but also non-military spending. And I think that no developed market government has paid a price for fiscal looseness in the last 10 years. There's just been no reaction with interest rates, and it has not made you less politically popular.
And MMT is obviously gathering momentum. Who knew this whole idea of modern monetary theory, this idea that deficits actually don't even matter, and that governments are not like households and they should be allowed to spend, ad infinitum. Very much gathering momentum in the economics arena.
But how much are they encouraged to spend more money because the interest rates are so low?
Well, I think it's kind of circular. It also becomes very blurred once you start to accept or maybe become a little bit skeptical about the independence of the Fed or more generally of monetary institutions.
Yeah, this kind of brings us back to the beginning with the central bank. If you have central banks that are willing and able to cut interest rates virtually to zero and you're able to grow spending, if you can do both of those things at once, nobody's going to complain.
Exactly.
Perpetual motion machine, we'll call it. Okay.
It's like being tall and blonde, basically, is what I'm told.
Okay, many thanks to our contributors, Dambisa Moyo and Brian Nick. That was another edition of Bloomberg Wall Street Week. See you next week.